Australia market analyst with Bell Potter. Today I'm joined by the chairman and CIO of Magellan Financial Group, Hamish Douglass. Hamish, thanks so much for your time.
It's a pleasure, Jessica, and great to be with you.
Well, thank you. So first up, we're really keen to get your take on global markets and how they're faring amid the pandemic. But first up, if we can start to this great divide that we're seeing, this huge gap between the underperformance of the US economy and the US stock market, do you think that this gap may close or continue to widen?
Yeah, well, Jessica, first of all, I would say that you often get these disconnects between economic data and stock markets, and particularly during when economies are down, because economic data tends to give you a snapshot today, and the market's really giving you a view of the future. So the market's all about trying to discount the prospects of businesses into the future, and the unemployment statistic is telling you what's going on in a photo today. So you often get a disconnect. You go, oh my God, the economy looks so bad, but the stock market's going up. How can that happen? And one is telling you something about the future, and the other one's telling you something about what's just going on at the moment. You're also asking the sort of a wider question between the US and the US stock market. What I would say to you, especially at the larger companies, most of the large companies in America are multinational businesses. So they're really reflecting what's going on in the world rather than what's just going on in the United States. So there is a difference between looking at the US stock market and just thinking about the United States, because most of the big businesses in America operate everywhere in the world. They're just not American businesses. And if I thought about what's going on in the stock market itself at the moment, really, what's the market doing? And I think there's two principal views the market's taking at the moment. The first view is they're taking a view, and in aggregate, the market is anticipating sometime in 2021, we're going to probably get a vaccine, and we're going to be rolling that out at scale around the world, and we're going to be exiting this pandemic in 2021. And that's an assumption by the market. You know, we've got over 100 vaccines in development. We've got 6 vaccines in phase 3 trials, and and politicians are out there talking about buying and manufacturing vaccines. So people are making the assumption. What we would say to you is we just don't know. We don't know whether that sort of hope and assumption is correct. It's a question of science, and we only have one data point out of the phase 3 trials at the moment. And the only data point we have this week, it came out from AstraZeneca, is they've paused their trial because they had 2 adverse reactions, which they don't know. One of them they think was not related to the vaccine, and the other one they don't know whether the adverse reaction was related to an existing condition of the patient or was a reaction to the vaccine. And the rest of the phase 3 trials, there's no information at all. It's only in their earlier, very small trials we have information. So what we'd say, the scientists don't know whether we're going to have an effective vaccine, but the markets are assuming we will. The markets may or may not be correct on that. And actually, we don't know it. Magellan, we don't know. The scientists don't know. And it's pure speculation at this point. The second thing the markets are factoring in is they're factoring in low interest rates prevailing for an extended period of time. Obviously, we've seen a massive amount of stimulus, but a massive activity by the central banks to really lower interest rates. And we think for an extended period of time, that is likely to be correct, that we're going to have low inflation and low interest rates for an extended period of time. And that is supportive of higher valuations. So these two effects is we're going to get out of this next year and we're going to have lower interest rates. You probably add that together. It's not surprising why markets have been strong here, and combine that with the amount of government stimulus and bond buying by central banks and all the money flushing around in the system, you can probably now you could understand what markets have been doing. That doesn't mean markets are correct. And I think it's a great unknown whether they're correct about we're going to get out of this pandemic next year. We're not going to know until we get much better data coming out of these phase 3 trials.
Yeah. So definitely a lot more uncertainty, but one thing is for certain, the US presidential election is in November. What is Magellan thinking about this? What will this likely, or how will it impact markets? And what changes have you made to your portfolios?
Yeah, another very timely question. We're getting quite close to the US election now. Most people are very focused on the Biden versus Trump run for the White House. And largely, we would say that doesn't make a lot of difference in terms of what's likely to happen and what the market reaction will be. You need to get really into the grains of US politics to understand where would the markets react to an outcome of this election. If Trump gets in, there won't be a big reaction. Actually, if Biden gets in and the Republicans keep the Senate, there won't be a large reaction because the president and the Democrats can't do very much without controlling the Senate. So really, in order to start thinking about the consequences of an adverse market reaction, you need to think about, it would most likely have to be a Biden win. They would have to retain the House of Representatives, the lower house, but they would actually have to take control of the Senate. There's 100 senators in America and 35 are up for election. They have 1/3 election. There's actually 2 special elections this round. The majority of those are going up for the Republicans, but the Republicans currently at 57, and there are you need to 53. There's 53 Republican senators and 47 Democratic senators. So the Democrats have to pick up a minimum of 3 and the White House, because the Vice President has the casting vote if it's a tie, in order to be able to pass budgetary legislation. But in order to make fundamental changes with legislation, there's a very important Senate rule, is that in order to pass normal legislation, you need a supermajority. It's unlike our system where a simple majority of senators pass. You need 60 out of the 100 senators. And they're never going to get to 60 senators. But what is being floated at the moment is if they took control of the Senate, they would have to change the Senate rules to change their voting procedures. Instead of 60 votes, make it 51 votes. It's something called getting rid of the filibuster. And Obama's actually put this on the table fairly recently at a speech. It was actually at George Lloyd's eulogy where he put this on the table, it's time to get rid of this Senate rule, the filibuster, if we take control. And the carrot he's putting out there is, let's make the 2 districts, the District of Columbia and Puerto Rico, states. And if they make them states, every state gets 2 senators. So he's going, don't worry if we change the rules that the Republicans will then next time around if they control the Senate. He goes, well, we could stack the Senate by introducing 2 more states into the union. So I would say to you, what you have to watch on election night isn't who wins the White House, it's who wins the Senate race. Then ultimately start Googling something called the filibuster and work out what the Democratic senators are saying of their willingness to change the rules. And if that falls, if they win the lower house and the Senate and the White House, I suspect markets will be jittery, because then they would think, is if they're going to do this, what legislation will they start passing, and will it be adverse to markets? But if the Republicans keep the Senate, and the polls of them keeping the Senate is about 50-50. So even though Biden appears to be well advanced in the race to the White House, but that's tightening at the moment, and they seem to be well ahead in the lower house race, the Senate's very, very tight. And that's why you're probably not seeing a lot of market reaction at the moment to even the Democrats getting in. You've asked, what have we done? We've actually reduced some of our healthcare exposure, because we know if the Democrats take this, one of the things they will want to do is further healthcare reform in the United States, following on from Obamacare. And some of that could be detrimental to the profitability of healthcare stocks. So we have reduced our healthcare stocks, but otherwise we're not overly concerned about the US election. But it's going to be a very interesting election night, and we're going to be watching the Senate very closely. And we're watching those close Senate races and what the opinion polls are saying on those fairly closely at the moment.
Mm-hmm. So you've reduced your healthcare exposure, but your last portfolio review showed that you had about 15% in cash. So what's your cash position now? And what are you really waiting for, Hamish, as a trigger to start deploying some of that cash?
Yeah, we've reduced our cash position moderately since then. Part of the reduction is just markets have gone up and cash is a static number and the equities are going up in value. So just as a percentage of the portfolio, your cash shifts down when markets go up. But we've made a few small investments in things that we think are very resilient to or indifferent to the outcome of the pandemic. I can't disclose the names of those, but they were at prices that we liked and we thought that they don't have a lot of downside if the pandemic continues for an extended period. But what would make us fundamentally shift out of the cash, and I think it really depends upon what happens in these phase 3 drug trials and whether we're really going to get an exit from this next year. If these drug trials fail and we get a material market sell-off, we would be prepared to buy even if people are panicking. You know, the classic old Buffett adage, you know, you want to be greedy when others are fearful and fearful when others are greedy. You know, so if we got a major sell-off because people work out that it's going to take longer to exit this and we think that's in the price, we'd be happy to increase risk. Or if these trials are successful and we think that really there's going to be an exit from these sort of shutdowns next year through vaccination on a large scale, markets probably are going to be fairly strong in that environment, but then we'd say it may be inappropriate to be holding as much cash. So very different world. We could either be buying when people are panicking or buying when it's clearer that the risk has receded around an extension of the timetable for this from this pandemic. So we're prepared for both sort of outcomes, you know.
Yeah. Thanks for that, Hamish. So you did say that you're getting out of healthcare or reducing healthcare.
Reduced. We sold our position in a company called Health Hospitals Corporation of America, which is HCA, which is the largest hospitals operator in America. And if they effectively increase Medicare by reducing the Medicare age, more and more people go into the government payment option out of commercial payment, and that mix shift would actually reduce the profitability of HCA. So, you know, we've actually sold the position in that. It's a great company with very, very good management, but we want to have clarity on where the regulations are headed.
Definitely. And you did say that you've been deploying some of that cash. You've reduced your cash.
Moderately, I said moderately, yeah.
Yeah, moderately. So I understand you don't want to disclose the name, but what sector or what sectors have you been buying into?
Yeah, well, let's take the story back a little bit. You know, if I go back to sort of March, we increased our cash and reduced our exposure to things that we thought were most sensitive to shutting down the economies as a consequence of the pandemic or risks in emerging markets. So we sold our two major brewing holdings, Heineken and ABI. They've got 50% of their earnings coming out of the major emerging markets, particularly Latin America and Africa. And we were very nervous or concerned that a very bad pandemic outcome could lead to an economic crisis in those countries and a currency crisis. And with 50% of your earnings sitting in those areas of the world, we're going, well, we're not going to wait around to find out how bad it gets. We sold down an investment we really, really like, but it's very discretionary, Louis Vuitton, LVMH. You know, we don't think Louis Vuitton handbags and Dom Perignon and Veuve Clicquot are essential goods. Well, maybe fortunately or unfortunately, it's a great company by the way. So we sold that down. It had rallied strongly through sort of April and May, and we sold into that strength. We had bought some more of the defensive businesses, US utilities, and we had bought out of some of the sell down. We had bought some more exposure to the big two Chinese technology companies, Alibaba and Tencent. But what have we done very recently? I don't want to disclose the names, but we bought one of the global stock exchange and derivative businesses that we think has. It's interesting that if you get a very bad outcome, volatility goes up, and their earnings are actually skewed to volatility going up and more trading. So a bad outcome is actually good for their business. but they're very, very well also positioned in the medium to long term. So we think that's quite sort of pandemic resistant, and they're doing a few things, and we just like the opportunity. So we kind of took the opportunity because it was not the outcome of the course of the pandemic wasn't a decision point for us on that business. And we bought into a video streaming business. I'll let you speculate what that is. But the nice thing about video streaming, a bit like pay television and cigarettes, they're the last things that people give up in a recession. And we're not going to invest in tobacco, by the way. We're not interested in tobacco. But pay television or streaming is almost an essential good for many people. The pandemic has been very favourable of accelerating the trends towards streaming and away from traditional pay television and broadcast television. That is strengthening their businesses. But we're taking a 10 to 20 year view in that space. But again, because of the nature, the pandemic is actually helping their business model, and therefore we don't have to wait for the outcome of the pandemic on a business like that. But we haven't disclosed the name, but people can speculate on what the names of those businesses may be.
Speculate away. But something is for certain. You mentioned Alibaba and Tencent, and you've got an increased focus on China-based investments indeed. But could this position change? Because we know that the US is looking to ban TikTok, WeChat, and Tencent.
It's a very, very good question. This underlying tension between the United States and China isn't about to disappear with this election. It's very elevated in terms of this because Trump's trying to make a big issue about China and blame them for the virus, and it wasn't his fault. And so I think you'll see other announcements. Some of them may have national security implications and some may not. This is a national security issue ultimately around technology. I'm not sure TikTok is the world's greatest national security threat. I think it may be more politics than anything else. Watching a video of a cat jump over a dog doesn't is the world's greatest national security threat, nor the data you may be collecting on those people who are watching those things. And it's interesting, other countries haven't followed the TikTok ban, but they have followed the Huawei ban. So Huawei, you can understand in your 5G networks of installing equipment, could actually have real national security issues. But some of this is national security and some of it isn't. You're asking Tencent and Alibaba, Tencent's WeChat, which is a messaging platform, is being banned in the United States. Less than 2% of Tencent's business is in the United States. And Alibaba has very small business in the United States. It's really an export from Chinese goods to US and their AliExpress platform. These are largely Chinese domestic businesses, and the US really doesn't have reach to really damage their Chinese businesses that are very, very well positioned. So with this war, we're not that concerned that this sort of dispute between the US and China is really going to affect Alibaba and Tencent. Perversely, we're probably more concerned about could Starbucks get caught up in this battle, even though it's not a technology company, because if the US takes certain actions that damage Chinese businesses, they banned Huawei, but they're now trying to shut them out of computer chips, semiconductors as they're known. At some point, China may want to send a message that we can harm your American businesses in China as well. And it wouldn't take much on state-based media to send a message to the population: we don't want you carrying around a Starbucks coffee cup in your hand. So we're watching that. Starbucks has a wonderful business with 6,000 stores in China. It probably over 20 or 30 years can roll out maybe 30,000 stores in China, and they're generating over 80% return on capital and opening up a new store in China. So it's a very, very big business prospect with a great management team in China and a wonderful management team that runs it globally, with a very advantaged position in China, but there are risks. So we take those risks into account. But it's interesting, where we see the risk in our investment in China aren't the ones that people may think of. They're probably things that people aren't thinking of is where the risk may be. So there are other, so we try to moderate, we're probably not going to own Nike and Starbucks and Apple and Yum and every big business that's American. You want to have some American interests, you want to have some European interests, you want to have some Chinese interests. accessing China and participating in the growth of China in the next 20 odd years is probably one of the most important investment calls to get right. But you need to navigate around these sort of geopolitical risks as well.
Mm. All right, so Alibaba and Tencent likely not to be a risk or at risk. Moving to some of the actual geopolitical risks, at Magellan, what do you see are the biggest risks in the market, and how is that impacting your stock selection?
Yeah, it's a really interesting question, Jessica, because there's always lots of risks out there. There's always lots of things in the headlines. So if you go around the world, you're thinking about Brexit. At the moment, you're thinking about US elections. We've just spoken about China, the pandemic itself. We've got monetary policy. We've got inflation threats out there. Our job is to really try and distill what matters and what doesn't matter. And if you went back 3 years or 5 years ago, there's always different risks out there, and there's lots of things in the news headlines. But frankly, a lot of them are noise and don't really can affect the cash flows of businesses over their life cycle, and they're not affecting valuations. But there are some things that could really fundamentally affect things. What future interest rates are going to be is a very, very important topic because it affects the valuation of every business. So where global monetary policy is going is a very important topic, and whether or not this sort of massive response we're seeing and the fiscal deficits and the printing of money by central banks is ultimately going to lead to inflation and higher interest rates is a very, very important question to answer. And we've got a panel of advisors that include Janet Yellen and Kevin Walsh, who used to be on the Federal Reserve as well. And that is a big topic that we debate. And I'd say that is a very, very important topic. And that's not going to disappear post the US election or anything else. This is an ongoing issue that you need to take into account. The other big issue at the moment is just the pandemic itself. And that's a scientific question. We really have to, there's a lot of damage that's been done every time we shut down. So, the economic damage is getting worse by the shutdowns in Victoria. It's likely that Spain and France are going to start shutting down again in response to their waves. America's going to go into winter. They may well get shutdowns. If these vaccines don't work, we're going to have this happen next year and maybe the year after as well. And every time it happens, more damage is done, and ultimately more businesses will go bankrupt. And that really matters. So how quickly we can get out of this is a very important question. And to us, it's a scientific question. Largely, we had a debate around the US elections, but we said it doesn't really matter. There is a tail risk around Democrats that you need to think about. For most answers, it's probably going to be a yawn. The American election, but every time, even in Australia, when we turn on our news, nearly the lead story is something what President Trump has said.
Yeah.
So everywhere around the world is caught up in the US election. I think we're going to hear an enormous amount in the next 6 weeks on Brexit again. Then outside some companies in the UK, Brexit is largely a non-event for most companies in the world. So you have to just distill what's important and what isn't, and then focus on the businesses that you own and what their future prospects are.
Well, we've covered a lot of territory today. From the US election to the Great Divide with the US market and the underperformance of the economy and the biggest risks and how you're reducing some healthcare exposure. I'd just like to end on the biggest opportunities that you see in this new COVID and post-COVID world, particularly amid the behavioural shifts caused by the lockdowns. So what are the big opportunities that you're seeing, and what are the behavioural shifts that are most kind of exciting, I guess, for you?
Yeah, well, a lot of these shifts were occurring, and they're already before this, but they're getting magnified. So if you accelerating digital engagement, because we've been locked at home and we've all been video streaming now, we've all got in a world where more of our lives have got digitally engaged. So we already had e-commerce occurring, but there's people who were never e-commerce shoppers have all been trying it out. So it's accelerated adoption and behaviour there. If you think about cloud computing, we're on a Zoom call at the moment. This is supported by the world's cloud infrastructure. Many businesses have forced their staff to go and work from home. They're now thought about their computer systems and how best to have their computer systems. There was a shift to the cloud, but we've probably brought forward a number of years of behaviour, and more companies are going to invest in their shift of their computer systems to the cloud. If you think about payments, cash has almost become a dirty commodity. No one wants to touch it. We knew there was a shift into digital forms of payments, but this is, particularly in countries like the United States, which was a cash economy, and then you had to always put your PIN numbers and sign for things. People now, for the very first time, are starting to tap and go in the United States, and it's accelerated their behaviour for payments companies. Payment companies also get benefit for the shift to e-commerce. When is the last time you paid cash on delivery for an e-commerce shipment? We've seen shifts in hygiene behaviours, which is probably going to be pretty long-lasting. We've probably got a further consequence of lower interest rates coming out of this. So we're thinking about all those behavioural changes. But on the other side of this, there are things that are losers as well. You could think about the accelerated shift to online shopping. That's going to have effect on real estate in the world, about the owners of shopping centres. As it shifts online, these stores become less profitable and therefore they can afford less rent. It's just not the shutdown that's going to affect these businesses. It's this acceleration to e-commerce is permanently changing the economics of physical retailing. And it means the system has to change, and therefore we're probably going to accelerate the decline in value of certain real estate. But there's a lot of debate around commercial real estate. Because we've been working from home, everyone's going, well, office buildings are dead. And I would say to you, I'm not sure that's so true. I just don't know that one, because personal interaction and collaboration is incredibly important. I think what this has done is enabled people to have much more productive lives and have a better work-life balance. But does this mean businesses can just shut all their offices and then have successful businesses? I'm sceptical that is the answer, even though a lot of people are saying that. So there are things that are happening where I don't think it's obvious that the trends will be permanent. Like on travel, people going, well, people aren't going to travel anymore. Well, I think leisure travel, I think is going to come back. But business travel may not come back to the same extent, because people may want to cost save and be more productive with video conference. But, when is the last time you went on a skiing holiday virtually on video conference? When is the last time you went to a restaurant by video? So there are certain experiences that you have to do in the physical world, and our job is then to try and split between what's structural and what isn't permanent here, and then make decisions. But it's super interesting what's occurring.
Absolutely. Just on that, I know I shouldn't be asking you another question, but I will. We've seen some fund managers in our building leave because for the fact that it's caused this permanent shift. People realise that, as you said, they can be more productive at home. So what about for you guys at Magellan? When do you think that you might get back to work? Do you think that you might increase your time spent at home? What does it look like for you?
Yeah, it's a very good question, Jessica. Believe it or not, I haven't been in the office since the 5th of March. Have not physically been in our office, and I've probably been more productive than I've been in years. And actually going to the office every day for 30 years, it's been very nice to miss out on that sort of hour of commute on the bus. I get to the bus to work every day and back. And it's actually been nice that I've suddenly generated an extra hour of my life of not being on that public transport. Also, I spend a lot of time travelling overseas to go and see companies we invest in and see our clients. Obviously, I can't do that. We're banned on Prisoner Island from leaving Australia. So even if I wanted to, I can't go and visit the clients and see them. So we've been doing it by video conference. And actually, we've found that has been very productive, because normally when I go and see a very well-known chief executive that we may have an investment in around the world, I may go with one other person, so there'll be two people in a meeting. we're now doing video conferences with these chief executives, but I'm now having 10 or 15 people from Magellan join those meetings. I could not go and take 10 or 15 people to a meeting in New York. They wouldn't let us in the door. But they're very happy to do it in this video conference world. And from a personal point of view, I would have been on 3 more trips since March overseas, and I haven't been on those trips. I've actually been home with the family, but I've had every one of those interactions, and I would say many of them more productive interactions. So what's the world going to come out of this is, I think we're going to offer our staff, we think it's very important we get our staff together to collaborate, and we get the social interactions and get that social fabric of our organisation, which is culture. And that can't be done just by video conference and keeping people permanently apart. So we're probably going to have a compulsory, at least a day a week, where everybody's in the office together. But then I think we're going to give individuals more freedom and flexibility to actually manage their lives and choose whether they want to be in the office or at home. Without this pandemic, we would have never got there, because everyone would have said it can't work, or no one's going to work, or people are just going to be on the golf course. And what we've learned from this pandemic is that's not how people behave. People can work very productively. And I think you will get more engaged employees by giving them more flexibility. But it's very important that you get the balance right, because you do need that culture and social fabric of bringing people together as well. So I think we're going to enter a new world, a more flexible world, but it's not going to be this world where we have everyone just on video and no one ever sees each other again physically. I think you need both here, but I think flexibility is super important to people, and it can work.
Definitely. Well, Hamish Douglass, thank you so much for your time and for your insights into this new flexible world. Really great to chat to you.
Jessica, thank you very much for having me.
And thank you for watching. For more information about global opportunities, please contact your Bell Potter advisor.